Hello everyone. Now it's going to be a little lecture on mutual funds. Mutual funds, or open-ended investment companies, are very popular. If you're going after a Series 6, that's going to be the major security that you're going to be selling. You're also going to be doing variables. But mutual funds have different classes. They have Class A, Class B, Class C. There's an I, and there's a bunch of other ones, but let's not worry about the I's and that. ABC. Let's just do the ABC. A, these are loaded funds. They charge a sales charge up front. When you go into the math section of these recordings and on your audios, you'll see how to figure out the sales charge. It cannot be more than 8.5%. It is the sales charge divided by the POP, the public offer price. Okay? So this is charged up front by the customer. That's how you make your living. Somebody gives you $100,000 in mutual funds, and maybe you charge them 5% between all the funds. So 5%, you're going to get so much money, depending on what your commission is based on how much is brought in. The gross commission would be 5%, but you'll get a percentage of that. Okay? What are they going to get? Let's just say, for example, it's $5,000. They give you $100,000. Their account is going to be worth $95,000 day one. $5,000 went to you or your company, and so much to you. On a B share, let's say they give you $100,000 and you're going to sell them a B share. Well, the B share backloaded. Backload means as long as they stay in there, they're not a sales charge yet. If they give you $100,000, there's $100,000 in that account. Depending on how long they stay in, that's going to determine the sales charge. And let's say your top is 6%, 5, 4, 3, 2, 1. So if they stay in for less than a year, you're going to charge them 6% when they leave. And it's going to be on the gross, or on what it grew to, or what it went down to. If it grew to 200, then it's 6% of 200. Okay? If they left really fast, took the profit. If they stayed 1 year, it's 5%. 2 years, 4. 3, 4, 5 years. At the 6th year, it's 0, no sales charge. So if they stayed 6 years or more, there's no sales charge at the end. They get the full value of the account. How do you make a living? Well, you make a living on the expense ratio or 12B1 fee. It's much higher than an A. Could be up to 0.75% a year. If it's a no-load fund, well, then all they do is charge a 12B1 fee for compensation to a distributor. That's what we'll do. We'll look at no loads. No load fund. Okay, so they give you $100,000. There's $100,000 working for them. Depending on how long they stay in there, that's going to determine their sales charge. C has no sales charge. Short term. When I started in the business, you had to take money and you had to give them right back to them. When they started trading, or they were in there a very short time and it was consistently doing that, we had to tell them, no, you're not allowed to invest in our funds anymore. Now they let them get into C shares because it has a much higher expense ratio 12B1 fee. It's high also. Mutual fund company will make it on the expense ratio, the 12B1 fee. That's part of distribution and marketing. So if it was sold by a distributor, a broker that's not directly with the company, they would get that probably. If you see a lot of discount brokerage firms say we got 7,000 mutual funds and we got 5,000 no-load funds, how do they make money? They make it on the 12B1 fee. They don't mind to make it a wee little bit if they're going to be holding billions and billions of dollars. And yes, it gets to that. So, this is a mutual fund. Open-ended means they can just keep cranking out shares and selling it any time. If you wanted to buy $100 million in shares of this XYZ mutual fund, you could. It doesn't matter how many dollars are in there. You're not trying to find somebody to buy it from. Okay? Like a stock. Or like a closed-ended fund that only has so many shares. There, you got to find somebody in the marketplace to trade with. Here, you just send the money to the mutual fund company and they print up shares for you. Send it out. But how do they determine the price? And don't worry, I'll get back to no-load fund. The net asset value. Net asset value. So at the end of the day, they tally up all the shares and the market price of those shares. Not of the fund, but of the securities inside the fund. So look into an annual report on the mutual fund that you like. It's going to list all the companies that are invested in there. All the bonds, all the stocks, everything that's in there. It's going to tell you how many shares it has. And then you're going to be able to look at the price and determine exactly what's in there. Now, as soon as a company prints up the annual report, the next day it's pretty much obsolete because there's trading going on and everything changes. But what they do for the net asset value, they take all the securities that are inside there, tally it up based on the price of closing that day. Okay? Then they take their expenses out. The mutual fund company does. So, net asset value, they start with gross asset. You don't see that on the test, you don't see that in the books. But that's what they do. They just basically tallying everything up. And take a look at the expense ratio of a mutual fund. Here's what you do. Total expense ratio. Let's say it's a stock fund and it's 1.5%. Okay, 1.5%. And let's say, for example, that, the total gross assets are $10 billion. Yeah, 10 billion. That's not much. Believe it or not, it's not much. So how does the mutual fund company make a living? They don't get the sales charge. You, the salesperson, do. They make a living on the expense ratio. And every day that there's a closing business day, there's typically 220 a year. 1.5. Turn that into a decimal. Right? 0.015. And then divide that by 220. You'll get some ridiculously low number. And then what you're going to do is you're going to take that number and you're going to multiply it every day the business closes by $10 billion. And that's how much the mutual fund company makes. That's the revenue it's generating for that mutual fund. That's how it keeps the lights on, pays the people, and makes a profit. Doesn't matter if the fund goes up or down. They're based on their performance. Their revenue is based on the fund going up. So it's in their best interest to get a very good portfolio manager and grow it. Now, that's not how you see a closed-ended fund. These are open-ended mutual funds. Okay? A closed-end fund, it's priced based on the marketplace. supply and demand. It could be below the net asset value. But a mutual fund cannot be sold below the net asset value. Open-ended must be sold at net asset value or net asset value plus a sales charge equals the pop. Do the equation. Net asset value plus the sales charge equals public offer price, pop. To figure out the sales percentage, okay, how much is the sales charge? Divided by the pop. That equals the sales charge percentage. Don't take it from NAV, you'll fail it. You'll fail the question. And you can count on it that FINRA or whoever's test you're taking did calculate sales charge divided by net asset value, and they put that as answer A or B. Where's your answer? Oh, your answer is C or D. But hey, you got that right. You had sales charge and net asset value. Hey, I see it here. Wrong. Sales charge divided by the pop. Okay? If you do it wrong and you're using the net asset value, yes, you're going to see it in A or B probably, because they're going to want you to stop, take the selection, and miss the question. Be careful, please. Okay, so total expense ratio. Divide that by the number of days in the year, business days. Multiply that small fraction by the gross asset. Okay. Now, once you figure out and you do the multiplication, now the expenses for the day you're taking out, now you got net asset value. And now you divide that by the number of outstanding shares, and you got your net asset value per share. Now, we're going to get back to the no-load funds. No-load funds sell at the NAV. They don't have a sales charge. Everything's internal. They don't have a sales charge. They're permitted a 12B1 fee for distribution and marketing. And that can be no more than 0.25%. Now you hear a lot about people saying, well, 12B1 fee, I don't like getting into funds with 12B1 fee. Really? Smack them upside the head. What's the difference? It's for distribution and marketing. You don't think the other funds have distribution and marketing expenses? Please. It's part of the expense rate, total expense ratio on that. Don't worry about it. I mean, it's going to be an expense on every fund. It's just not separate, specifically listed as a 12B1 fee. That's it. Now, if it wants to be a no-load, it cannot be greater than that. So, it does the calculation, takes the gross, gets it to the net asset value, and that's what it's sold at for those transactions for the day. Remember, you're not setting a price that people are going to buy it at when you're ready to sell it. This happens through the day. So, from the closing bell yesterday until the closing bell today, okay? Closing bell yesterday, okay? Now they're taking orders for the next day on this price, the price we just calculated. That's not for people who want to buy it tomorrow. No, they got to wait until the next closing. So your price for the mutual funds are always going to be the next closing price. It may be that same day. Oh, the market's closing in an hour. I'll get that mutual fund order in so that I can get today's price at the end of the business day. That's how it works. Okay? Now, things that you're going to have to read about on the open-ended funds. Let's take a few and then go. So we have letter of intent, accumulation rights, letter of intent, 13 months. You can backdate it. but the length cannot be more than 13 months. The whole idea is to, and these are for A shares. So this says I put in, let's say last month I put in $20,000 and I was charged 6%. I call my broker up and says, you know what, that's going pretty good. I want to put in another 20, another 20. I'm going to probably do 120 overall. Really? Well, if you do 120, you can get a sales charge of 4%. Really? I wish I knew that then. I could have done this. Oh yeah, we'll backdate it to this purchase and we'll credit you the extra couple percent that we charged you. And going forward, everything is going to be charged at 4% over this 13-month period. Now, if he does do what he intended, he's fine. But if he stops at 50,000, then at the end of this period, they're going to look at the sales charge for 50,000 level, and they're going to increase it. Maybe it's only 5%. So they'll add the extra sales charge based on the performance there. And they'll take it out retroactive. Okay. So letter of intent just, basically says this is how much I want to purchase overall, give me the lower sales charge. Now, the accumulation means, let's say I put in 20,000 and it was at 6%. And then it grew, and then I'm going to put in another 20,000. But it grew to 35. So my value would be 55,000. The sales charge is based on the value of the fund going up, plus contributions that you put in, and it's a way of getting a lower sales charge. So I'm putting in the same amount here as I did here. But this time I broke over a break-even point where I get a break on my sales charge. And now I'm only being charged 5%. If I get this up to 100, when I put money in on 100, even if it's just $10,000, I'm going to be given a sales charge based on the accumulated value, the total value. Mutual funds. Now, mutual funds come in all different objectives, different classifications. Take a look at them. Talk to me about it, how you want. Because suitability is also very important. Don't think just because you get into a mutual fund you're diversified. No. And don't think that the 75, 5, 10 rule by FINRA and that has anything to do with diversification. That's for the test. You don't go by this. You make sure that people are spread out on small, medium, and large companies. Maybe a little international if they can afford it. Maybe some debt. Maybe some bonds, short and long term. Okay? That's diversification. They're talking about diversification. This formula, learn it, but be careful. Be careful. Don't expect that to be true diversification of a portfolio just because it meets that one guideline on your mutual funds. Mutual funds are a nice way to help diversify, but it doesn't mean that you are, okay, if you get into them. Well, that's mutual funds. That's a start. Also look at the calculation for the sales charge percentage in the math section, okay? And ask questions.